My dear students, welcome back to our channel. In this video, I will be explaining the MBA 4th semester subject Financial Risk Management as prescribed by Osmania University and other universities of Telangana. We will go through the important questions and answers one by one. Let's begin with a quick revision. Unit 5 first important short question is: distinguish between call and put options. In financial markets, call and put options are like contracts used to buy or sell an asset, like shares, at a fixed price in the future. 1. Call option. It gives the buyer the right to buy an asset at a fixed price. For example, if Ramesh buys a call option for TCS at 100 rupees, and the market price goes to 120 rupees, he can still buy at 100 rupees and make 20 rupee profit. 2. Put option. It gives the buyer the right to sell an asset at a fixed price. For example, if Suresh buys a put option for Infosys at 150 rupees and the price falls to 130 rupees, he can still sell at 150 rupees and gain 20 rupees. Easy trick to remember. Call is equal to buy. Put is equal to sell. Call is useful when you expect the price to go up, and put is useful when you expect the price to go down. Next important short question is: 2. What is a European option? A European option is a type of option contract where the holder can exercise the option only on the expiry date, not before. This means you can buy, call, or sell, put, the asset at the agreed price only on the last day of the contract. Example: suppose Priya buys a European call option for Reliance shares with a strike price of 2000 rupees, expiring on 30th June. Even if the price becomes 2200 rupees on 15th June, she cannot exercise it early. She must wait until 30th June to use it. This is different from American options, where you can exercise anytime before expiry. Easy tip to remember. European is equal to only at end, E is equal to end. It gives less flexibility, but it is usually cheaper than American options. These are widely used in stock index options and currency options. Next important short question is: 3. Explain in the money, at the money, and out of the money in options. These terms show the current position of an option compared to the market price. 1. In the money, ITM. The option is already profitable. Example: a call option has a strike price of 100 rupees. If market price is 120 rupees, it's ITM because you can buy at 100 rupees and sell at 120 rupees. 2. At the money, ATM. The strike price is equal to the market price. Example: strike price 100 rupees and market price 100 rupees. No profit or loss yet. 3. Out of the money, OTM. The option has no profit currently. Example: a call option with strike price 120 rupee when market is 100 rupees. Buying at 120 rupee makes no sense now. Quick trick. In is equal to profit. At is equal to equal. Out is equal to no profit now. These terms help traders decide whether to exercise, hold, or ignore the option. Next important short question is: 4. Time value of options. Time value of an option is the extra amount a buyer is ready to pay above its current profit, intrinsic value. Because there is still time left before expiry. It reflects the chance that the option might become more profitable in the future. Formula: option price is equal to intrinsic value plus time value. Example: suppose a call option has a strike price of 100 rupees and the market price is 110 rupees. Intrinsic value is equal to 10 rupees. But the option is trading at 15 rupees. Time value is equal to 15 rupees to 10 rupees is equal to 5 rupees. This 5 rupees is paid because the buyer hopes the price may go even higher before expiry. As the expiry date comes closer, time value keeps decreasing. This is called time decay. Easy tip to remember. More time is equal to more value. Less time is equal to less value. Time value is like hope value in the market. Next important short question is 5 Assumptions of Binomial Option Pricing Model, BOPM. The Binomial Option Pricing Model, BOPM, is used to find the fair price of an option. It works by creating a tree of possible future prices. For this, the model makes some assumptions. 1. Only 2 outcomes. In each time period, the stock price can either go up or go down. 2. No dividends paid during the life of the option. 3. Markets are perfect. No transaction costs or taxes. 4. Risk-free interest rate is constant and known. 5. Investors are rational and aim to maximize profit. 6. Stock price changes are continuous and follow a known pattern. Example. If a share is 100 rupee today, in one period it may go up to 120 rupees or down to 80 rupees. Easy tip to remember. Binomial is equal to 2 outcomes is equal to up or down. These assumptions help us build a price tree step by step to calculate option value. Next. Unit 5. Long questions. First important long question is 1. Explain the definition of an option and also its various types in detail. An option is a financial contract that gives the buyer the right, but not the obligation, to buy or sell an asset, like shares, index, currency, etc., at a fixed price, called strike price, on or before a specific date. It is used in risk management to protect against price changes or to earn profits from price movements. 2 main types of options. 1. Call option. Gives the buyer the right to buy the asset at the strike price. Useful when you expect the price to go up. Example. You buy a call option for Reliance at 2000 rupees. If the market price goes to 2200 rupees, you still buy at 2000 rupees and make a profit of 200 rupees. 2. Put option. Gives the buyer the right to sell the asset at the strike price. Useful when you expect the price to go down. Example. You buy a put option for Infosys at 1500 rupees. If the market price drops to 1400 rupees, you can still sell at 1500 rupees and gain 100 rupees. Based on exercise style. 3. American option. Can be exercised anytime before expiry. Offers more flexibility. 4. European option. Can be exercised only on the expiry date. Less flexible but usually cheaper. Based on market position. In the money, ITM option is already profitable. At the money, ATM strike price is equal to market price. Out of the money, OTM no profit currently. Easy tip to remember. Call is equal to buy. Put is equal to sell. American is equal to anytime. European is equal to expiry only. Options are a smart way to manage financial risk and take advantage of price movements without buying the actual asset. Next important long question is 2. Distinguish between call and put options and their pricing methods. Call option versus put option. An option is a financial tool that gives you the right, not obligation, To buy or sell an asset at a fixed price, strike price, on or before a certain date. Let's understand the two types. Call option gives the right to buy an asset. Used when you expect the price will go up. Example, you buy a call option for Infosys at 1,400 rupees. If the market price goes to 1,550 rupees, you still buy at 1,400 rupees and gain 150 rupees. Put option gives the right to sell an asset. Used when you expect the price will go down. Example, you buy a put option for Reliance at 2,500 rupees. If the market falls to 2,300 rupees, you still sell at 2,500 rupees and gain 200 rupees. Differences at a glance. Feature call option, put option. Right to buy, sell. Used when price expected to rise, price expected to fall. Buyer's profit if price increases, if price decreases. Seller's profit if price stays below, if price stays above. Pricing methods of options. Two popular models are used to calculate the fair price, premium of options. 1. Binomial option pricing model, BOPM. Assumes prices move into steps up or down. Builds a tree of prices over time. Best for step-by-step calculation, easy for short periods. 2. Black-Scholes option pricing model, BSOPM. Used mainly for European options. Assumes prices move continuously. Needs factors like spot price, strike price, time to expiry, volatility, and risk-free rate. Quick memory tip. Call is equal to buy vertical bar, put is equal to sell. BOPM is equal to step-by-step vertical bar, BSOPM is equal to smooth curve. Knowing these helps you manage risk and decide whether buying or writing an option is profitable. Next important long question is 3. Explain Black-Scholes option pricing model, BSOPM, assumptions. The Black-Scholes option pricing model, BSOPM, is a mathematical formula used to find the fair value of European call and put options. It helps investors decide whether the option price in the market is fair or not. But to work correctly, this model depends on some important assumptions. Key assumptions of BSOPM. 1. The option is European type. It can be exercised only on the expiry date, not before. 2. No dividends during the option life. The stock does not pay any dividend before expiry. 3. Efficient markets. Prices reflect all available information. There's no chance to earn easy profits. 4. Constant risk-free rate. The risk-free interest rate remains the same during the life of the option. 5. Constant volatility. The price changes of the stock are consistent, measured using standard deviation. 6. Stock price movement is continuous. The stock price moves in a smooth and random way, no sudden jumps. 7. No transaction costs or taxes. Buying or selling the option does not include any extra charges. Example to understand. Imagine you want to price a call option on Infosys stock. You'll need current stock price, strike price, time to expiry, volatility of the stock, risk-free interest rate. Using BSOPM, you'll get the fair premium for that call option based on these values. Easy tip to remember assumptions, mnemonic, every nice cat sits calmly to rest. E. European option. N. No dividends. C. Constant interest rate. S. Stock price moves continuously. C. Constant volatility. T. Transaction costs is equal to 0. R. Rational markets, efficient. These assumptions help the BSOPM model give accurate and logical results. Next important long question is 4. The spot price of a share is 111 with a call option existing on it with an exercise price of 125 and 6 months to expiration. The volatility of the returns on the share is 27%. The risk-free rate with continuous compounding is 8%. PA dividends of 7.50 and 9.10 after 3 months and 6 months are expected on the equity share. Considering these dividends, find the value of the call option as per Black-Scholes model. Question summary. Spot price is 111 rupees. Strike price K 125 rupees. Time to expiry T 6 months is equal to 0.5 years. Volatility sigma 27% is equal to 0.27. Risk-free rate R 8% or 0.08. Continuous compounding. Dividends 7 rupees and 50 paise after 3 months, 9 rupees and 10 paise after 6 months. Use Black-Scholes formula to find call option value. Step 1. Adjust spot price for present value of dividends. We subtract the present value, PV, of dividends from the spot price. PV of 7 rupees and 50 paise after 3 months is equal to 7 rupees and 35 paise. PV of 9 rupees and 10 paise after 6 months is equal to 8 rupees and 75 paise. Total PV of dividends 7 rupees and 35 paise plus 8 rupees and 75 paise is equal to 16 rupees and 10 paise. Adjusted spot price S is equal to 111 rupees to 16.10 rupees is equal to 94.90 asterisk. Step 2. Apply Black-Scholes formula. We use values. D1 is equal to 1.14. D2 is equal to 1.331. Step 3. Use normal distribution values. From Z table. N, D is equal to minus 1.14, 0.1271. N, D is equal to minus 1.33, 0.0918. Now apply the call option price formula. C is equal to 1 rupee and 3 paise. Final answer. The value of the call option is approximately 1 rupee and 3 paise. Easy tip to remember. Subtract PV of dividends from spot price. Use D1 and D2 formulas. Use Z table for N, D1, N, D2. Plug into Black-Scholes formula. Next important long question is 5. The spot price of an equity share is 40 with a volatility of 25% in its price over the 3-month period of the call option on it. The exercise price of the call option is 4.4. The risk-free rate is 12% per annum. You are required to give the diagrammatic presentation of two-step binomial process over 6 months to expiration. Find the probability of increase and decrease in price at two levels after 3 months, 6 months and find the price of the call option. Given. Spot price S 40 rupees. Strike price K 44 rupees. Volatility sigma 25% is equal to 0.25. Time to expiry T 6 months is equal to 0.5 years. Steps 2. Each step is equal to 3 months or 0.25 years. Risk-free rate are 12% or 0.12. Continuous compounding. Step 1. Calculate up, U, and down, D, factors. Formula. So, up factor, U 1.1331. Down factor, D 0.8827. Step 2. Calculate risk-neutral probability, P. So, probability of up, P 0.59. Probability of down, 1, P 0.41. Step 3. Construct binomial tree, 2 steps. After 0 months, start. 40 rupees, current price. After 3 months, step 1. Up is equal to 40 rupees times 1.133145 rupees and 32 paise. Down is equal to 40 rupees times 0.88 to 735 rupees and 31 paise. After 6 months, step 2. Up is equal to 45 rupees and 32 paise times 1.133151 rupees and 32 paise. Up down is equal to 45 rupees and 32 paise times 0.88 to 739 rupees and 98 paise. Down up is equal to 35 rupees and 31 paise times 1.133139 rupees and 98 paise. Down is equal to 35 rupees and 31 paise times 0.88 to 731 rupees and 18 paise. Step 4. Calculate option value at each final node. We use call payoff is equal to max SK 0. At 51 rupees and 32 paise 51.32 rupees to 44 rupees is equal to 7 rupees and 32 paise. At 39 rupees and 98 paise 0 rupees, no gain. At 39 rupees and 98 paise 0 rupees. At 31 rupees and 18 paise 0 rupees. Step 5. Work backward to find present option price. Use the formula. Step 2. Step 1. For 45 rupees and 32 paise, up node. C is equal to 4 rupees and 19 paise. For 35 rupees and 31 paise, down node. C is equal to 0 rupees. Step 1 today. C is equal to 472 rupees and 40 paise. Final answer. Call option price is equal to 2 rupees and 40 paise. Up probability is equal to 0.59. Down probability is equal to 0.41. Bonus diagram of price tree. You can draw this in your notebook easily.